It's Rob McGregor, and it's the 27th of April, and welcome to this month's edition of On Track. Recording this after another interesting month, and there's lots to unpack, lots to talk about. Before I dive in, let me just do the usual warning. This is prepared for clients of McGregor Wealth Management, particularly those using our care investment methodology and process and portfolios. For everyone else, you're welcome to listen, but please don't act on anything I talk about here without getting advice that's specific to your own circumstances. So much going on in all the world markets, fascinating times. I'm going to go through all the key markets, what's happening, and always reminded of the great Warren Buffett's quotes, be fearful when others are greedy and greedy when others are fearful. Never been more true than in the last month. As is true wisdom, always comes through in the long run. So let's talk about what's happening. According to Donald Trump, the war's over. Maybe. It doesn't quite look like that. It looks like on again, off again. And it's interesting watching the numbers. I've been traveling for 3 weeks, the last 3 weeks throughout Asia, on a surf trip with my son, which was most enjoyable, and a few other bits. But watching the news every morning, I'd check two things: what's happening to the oil price. You'll see that chart down the bottom, and every time it goes up, oops, maybe not so ceasefire. Every time it goes down, and we saw, and the interesting thing about this is, I don't think anyone's really worried about the war, and I don't mean that there's not lots of horrible stuff going there. I mean, the thing that worries most people here is what's happening through the Strait of Hormuz, which is where that oil, 20% of the world oil goes through. So that's what's caused oil prices to go up. So what people are really looking at is what's happening there. There is no substantial reopening of that. The US is blockading that to try and put pressure on Iran. If Iran can't get their own oil out, it costs them hundreds of millions of dollars. So it's the negotiations here are complicated. The US looks like they have a deal one day, and that's because they're talking predominantly to the foreign minister in Iran. But then the next day it looks like it's off, because ultimately the power lies with Iran's Revolutionary Guard, which is the army, supposedly led by the Ayatollah, who's now the son of the previous Ayatollah, who hasn't been heard directly from since the day one of the bombing, when he was badly injured and his father was killed. You can imagine that he probably doesn't love the Americans. So we're seeing the public face of Iran says yes, agrees to a ceasefire, but then it gets overruled. So who knows? The real question here is what's happening. Now, the share market, ironically, has looked through this. You can see the NASDAQ chart in the middle, the blue chart there, just the incredible rebound. You see the weakness that went with the war, then bang. As soon as it looked like there was some bit of resolution, the share market has rebounded, led strongly by the Magnificent Seven, Big Tech, and NASDAQ. And there's reasons for that, which I'm going to talk through today. It's because AI is bounding ahead, profit forecasts are strong. The share market wants to look the other way. But the other two numbers are, so obviously watching share markets, but then, while traveling, I was watching the oil price, and you can see it dropped. You can see a big drop there from 110, dropped below 100, and then it got down to about 90. But then it's bounced back up the last few days as we go, well, this doesn't really look like a ceasefire. There's still stuff going on, and the news is there. So what people are worried about, as I talked about last month, is inflation. So right now, inflation resulting from increased transport costs, which affects everything that you buy. There's not much that you buy except online, but it still affects the delivery of any physical products. But from food prices to clearly petrol prices to cost of transport, which affects everything, it will flow through into the system. Right now, keep in mind, they don't report inflation until after the event. So you're going to start to see inflationary numbers in the next couple of months. We're going to have a similar conversation that was had during COVID, which will be people will panic because we've got inflation, but then there'll be discussions about whether inflation is transitory or more permanent and stuck in the system. It's likely to be transitory unless this crisis goes for significantly longer than is currently expected. Now, if inflation's transitory, it's not a problem. We'll all look back like we did in COVID and go, yeah, there was nothing to worry about. But if it gets stuck in the system, if it gets stuck in the wage increases, that's when people worry about a stagflation environment. The chances, and stagflation is just where we're not growing the economy, but we've got inflation, and that's what we had during the 70s and 80s, and that's what people worry about. It's quite unlikely. It's not impossible. And I'll give you an example I don't think will happen, but if the Strait of Hormuz was closed long term and there was other issues came up in the world, then potentially if inflation was sticky for a couple of years, then that creates a risk of stagflation. But there's opposite forces as well. Technological growth, AI, etc., are deflationary forces. So once we get through some of this, we should see a return to lower inflation. The question is how long that takes. Bond yields, which I'll get to in a minute, the charts remain high. They haven't settled at pre-war level. So 3 markets to look at. Share market wants to get on with it. It's ignoring the war to some degree. Oil prices, not quite. They have not they've not fallen anywhere near pre-crisis levels, where they were down around $60 a barrel for Brent crude, still at about 105, and it's actually jumped up the last few days as this ceasefire/deal looks more and more fragile. So, and bond markets, and I'll show in a minute, they haven't returned. You got Australian government bonds still at 4.99%, so still well above those levels. US ones still high as well. As we look down the numbers, cash rate after 2 hikes at 4.1, still no change in the last month. 90-day bills reflecting that 4.3, 10-year government bond yields at 4.99. US cash rate lower than Australian cash rate, 3.64. That's caused the Aussie dollar to go up. Investors like investing away from the US and into Aussie when we've got a higher cash rate. The Aussie dollar touched on 72 cents last week. CPI still steady at 3.5, but that number may go up. US inflation, you can see, jumped from 2.4% to 3.3%. So starting to see a little bit of the oil price in the inflation numbers, but not meaningful at this point. We'll see what happens the next few months. Keep in mind, it's a rear vision mirror number. It's telling you what happened, not what's going to happen. Mortgage rates have come up with the cash rate and likely to continue. And the variable rate, about 5.94 is one of the better ones you can get. And ironically, for investors that don't have mortgages, term deposit rates back in the 5s. So that's good news for them, not so good for people with big mortgages. Portfolio returns continue to be solid. They're negative in the previous month. You can see growth portfolios, balanced portfolios down about 5 to 7% in the 1 month. That's nearly all recovered, by the way. So that's to the end of March, with the increase as I put these numbers together, which was over the weekend. We've almost recovered that, but we might see some weakness in coming days if that oil price stays high and there's more doubts about the resolution. In the longer run, if I look through, care balance, for instance, 1 year 8%, 3 years 9.55, 5 years 7, 7 years 7, 10 years nearly 8%. So stellar returns, great quality in the long run. We had our investment committee meeting last Thursday, which I dialed in from overseas, as I do when I'm traveling. Technology is amazing these days. The facilities that we have when any of us are traveling means it's like being in the room. Doesn't matter where in the world we are, as long as we have an internet connection. We did put the dial back up to 10. It was absolutely down to 9. It was contemplating going to 8 at the bottom, but then prices are straight back up. So we're back to pre-crisis highs. Now, there's some reasons for that I'm going to talk through. Profit growth in Australia and the US is looking strong. How much the analysts that are analysing individual companies are taking into account transitory inflation, higher interest rates is hard to tell, but at the moment they're positive, and that's why we've seen the share market go up. That means it's a little high. This doesn't mean you need to panic, take profits or anything. It just means for our clients with new money, or new clients coming in that are investing cash. We're just cautious. And at 10, we'd invest between a third and a half upfront, spread the rest over 12 months, and take advantage of any opportunities that come up through dips, which we did. So there was 2 of those opportunities during the oil crisis as price dropped for people that we were averaging in money for. So that means they're buying in at less than they would have if they just put it all in at once, which is the whole purpose of our money on the move modeling. You can see this crisis, and we'll do some measurements next month. It's probably just around 12%, but we'll see where the bottom is. I tend to not to call it over until it passes back to the high, which is getting closer. But you can see it's not even in the league of the other so-called crises we've had over the last 20 years. Clearly the big ones, GFC and COVID, but then there's plenty of others in that 12, 17, 15% range, 14% last year on the Trump tariff tantrums. So this crisis is not at this stage any worse than those. It's actually less bad. We'll see where it finishes. And once again, I love a good quote from a wise individual, Peter Lynch, who was one of the great fund managers through the 70s and 80s with Fidelity, once said, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So the fear of something happening causes people to do silly things, not our clients, fortunately, and that causes them to lose money. I'm going to reinforce that in a lot of stuff today. So the yield curve, which is the 10-year government bond yields, they dropped. You can see we're sitting, about 0.5% above rates of about 6 months ago. So you can see pre this war, at the top right-hand corner is the US. Interest rates, 10-year bond rates got below 4%. They then went all the way up to 4.45, about 4.25 at the moment. So the bond markets are acknowledging that things are better, but they're not saying this is solved. Whereas share markets are looking ahead, bond markets saying, yeah, not just yet. There's still stuff going on. We want to see how this resolves, particularly around inflation and interest rates. The Aussie market, once again, was down to about 4.6 pre this crisis, up to above 5 and sitting on 5% at the moment. And the Aussie bond yield is higher than the US at the moment. And the thing that's driving that is just our higher inflation and higher interest rates and the uncertainty, less growth in our economy as well, and uncertainty about how that resolves in Australia. And I'll talk more about that in a minute. In my exciting life, boring money editorial piece today, I'm not going to actually talk about all the failures, but the successes long term. And I'm reminded, and there's a quote there from, it's attributed to Benjamin Graham. It's actually fought over as to whether it was Benjamin Graham or Warren Buffett. And of course, Benjamin Graham was Warren Buffett's teacher. So it's probably a mix of both. But the quote is, in the short run, the market's a voting machine, but in the long run, it's a weighing machine. That means in the short run, people vote. It's like a popularity contest. It's like as Warren Buffett also says, it's like a bipolar, a manic depressive. It's all over the place. But in the long run, it counts profits. Top right-hand corner, you'll see a chart of the S&P 500, which is the blue line, and a chart of the forward 12-month earnings per share forecast. So you can see in the last year that forecast earnings has jumped substantially. We've gone from earnings for the S&P 500 of about 280 up to 340. So that was prompting the market to go up before it went down with this crisis, and you can see it's gone back up again. So the key really is the profit growth in Australia. I've thrown a graph from our investment community report in here that shows the earnings forecast for the S&P 200. That's the ASX 200. PE currently is 20.6, which sounds high. But when you look at the earnings forecast 3 years out, you'll see on the right-hand side this remarkable jump where analysts are forecasting much higher earnings for Australian shares. Now, Australian shares are dominated. The ASX 200 is dominated by the big 10, which is predominantly banks and mining companies, BHP, Rio, etc. So changes in the forecast for the banks, etc., cause that to go up. It remains to be seen how these are bottom-up calls. Bottom-up just means all these analysts are analysing individual companies like BHP, Commonwealth Bank, etc. they add up all the earnings forecasts and they get this. There's not necessarily a top-down impact, which is where you look at what's happening with global growth, Australian growth, inflation, etc. You would think they're taking them into account, but it's always hard to tell, and this can be quite volatile. But if you look, that's a 10-year chart, that bottom left one. So in the last 10 years, you can see that earnings have grown well. Once again, that's what causes share markets to go up boringly in the long run. It's the fact that overall, good company earnings go up over time with occasional little aberrations. Continuing on with that theme, yeah, so many people attempt to time the market, but it's just so hard. It's a great chart that came out, and it's from came off Bloomberg from Global Asset Management. But as at the end of March, it looked at the return of $1,000 in the S&P 500 in 1954. And if you just stayed invested and ignored all the market ups and downs, which includes so many things, that $1,000 grew to 178,000. If you missed the 5 best days, that was only 110,000. And if you missed the 60 best days over that period, your return was only 7,800. So that's 170,000 difference. Quite staggering. Now, it does mean, people that attempt to time are trying to miss the worst days as well. But often these best days happen. One of them was last week. So where the market just jumped 7% in one day, as it was 2 weeks ago, as the world thought, all right, this crisis is resolving, and the market jumped. Now, if you're trying to time markets, if you're out of the market, you miss those gains, and you can see the challenge with that in the long run is nuts. So the difference between those, and here's where we jump to the chart on the right, and this shows, this is from Morningstar, the percentage of underperforming active Australian funds. So these are managers in Australia who are trying to make lots of decisions. So unlike the passive index investing that makes up 70 to 85% of your portfolios, these are active managers who are trying to make decisions based on their analysis and news and everything else. So you can see that, and this shows 1 year, 3 year, 5 year, 10 years, 15 in the colors. So the green is the 15-year, the blue is the 1 year. Then it shows for international, Australian general, and then Australian small caps, Australian property, and Australian bonds. And for international shares, you can see that over 15 years, 96% of managers underperform the market. In the last year, 70% have. So it's not that some don't outperform. So in the last year, 30% outperformed, but trying to find those in advance is almost impossible. And in the long run, it's a losing game. 87% of Australian managers in the last 15 years have failed to outperform the market. 60% of small caps, so there's more success in small caps, but it's still the majority. And you can see over the last 10 years, 80% have failed there as well. For property trusts, or A-REITs as they call it, 75% over 10 years, 88% over 15 years fail to beat the market. And in the bond market, it's a little better in the short term, but not so good in the long term. So call it across all of those, an average of 80% of funds underperform the market, which is why we like index funds as the core, with a little bit of wisdom around key events. So instead of all these active managers are trying to pick stuff every day, every month, and move portfolios around to react, we think that's a losing game, as is shown here. If 80% of professional funds fail to do it, it's clearly a losing game in the long run. We do, however, think the occasional bits of wisdom, and if you go back to that chart of our performance, our active portfolio, where we make the odd wisdom-based timing decision to be out of the market when times are a bit volatile, that fund has achieved a 12% return over 10 years. But it's off only 4 or 5 key decisions, and currently riding through one of those at the moment. So timing, incredibly difficult to do, even though there's whole industries built around trying to do that. I've updated at the start of the year, I did the 6 tailwinds, 6 headwinds, and 6 potential black swans that might dominate this year. And I thought I'd continue to do a revisit of that So we've still got very strongly the global growth of earnings, which is a tailwind, which is good for long-term share prices. We've still got an amazing amount of spending going on in IT, particularly around the manufacturing, so the production of AI is causing just literally unprecedented amounts to be spent on the war to create the best AI. We are seeing, we thought we would have a tailwind of lower interest rates. That is paused at the moment. That may come back, but right now rates have gone up because of the Iran US war. Governments are still spending. That's a tailwind. It's not good in the long run for lots of things, but for the share market in the short term, that's still a tailwind. Corporate balance sheets are still really strong. Household balance sheets more neutral. We're seeing whenever you get there's a large part of the economy right now, a large part of the population that have double whammy of higher interest rates on their mortgages and higher petrol costs. So for young families, unfortunately, which is the hardest hit, they've got potentially $200 to $400 a month worse off just by a combination of petrol and mortgage rates. Now, if they're not spending that if they've got to spend that on higher mortgage rates and oil prices, that's less they've got to spend on a whole lot of other things. So that will have an impact on some businesses. But even the money that gets spent on higher oil price and higher interest rates does go to companies in terms of banks, etc. So there's always profitability. In the headwinds, inflation is the fear and the geopolitical noise, which is all based around Iran. It's funny. The news has forgotten the other war that's been going on, which is the Russia-Ukraine war, which at the time it started, there was as much, if not more, concern than this one. So we forget quickly that one's still going, hasn't resolved, but the market stopped looking at it a long time ago. And the black swans, the rate hikes is the big one. It looks like it's going to be transitory. Everything at the moment looks like getting to some sort of negotiated settlement. It's just a matter of how long, particularly around that Strait of Hormuz, which is the geopolitical event that has hit. The possibility still is if we get through that big potential positive black swan is the not too much going on in the world and the AI-driven boom takes over. So all in all, kind of neutral, and the markets are ticking away accordingly. The key strategies out of that is diversification, avoid the single theme issues, keep some powder dry all the time for opportunity and liquidity so you can jump on dips or at least never have to sell. And that long-term focus with short-term awareness, which hopefully is what we hope you do. The dial, as I said, at 10, I'm not going to go through the recoveries, which we're already seeing. And in the mess it up section, I've already re-emphasized the timing selection, how hard that is, particularly through random crises like this. And the challenge is when markets drop, if you're active, you tend to be active by then selling things. Some people might be buying if they were cashed up, etc. But very hard to make money being reactive, which is what we see in those Dalbar numbers, which is for the average investor. So we know professionals can't beat the market 80% of the time, and the average investor underperforms by about 2% because of that over 10-year periods. Behavioral bias, everything looks rosy in the rearview mirror, or everything looks easy, I should say, in the rearview mirror. In other words, of course this crisis was going to resolve. Of course it was never going to go down by more. Is easy to say now, but at the peak when it was down, that's because people are worried, and that's always the case. So, but later on, we justify, and we collectively justify that we kind of knew what was going to happen. But history shows we don't, particularly around the way we invest. And this hindsight bias, as summarised here, says it may manifest as a sense of frustration or regret and not having acted in advance of an event that moves the market. It just is almost impossible once again. A little hidden workhorse through all this volatility, which I've highlighted here amongst the 4 pillars, is rebalancing. So as share markets dropped, we take the simple action of buying some more shares and selling some bonds. That's rebalancing. And when the share markets rise back up again, we sell some shares and buy some bonds. Now, all this is done at the margin. It's not the whole portfolio. if you had a portfolio that was 50% shares and 50% bonds, and the share market drops, you're taking it back to 50-50, and then as the share market rises again, you're then reducing it by selling. So that makes money because you're buying low and selling high. So they're little bits of money, but it covers the cost of good investment management. Just looking at the markets, you'll see Aussie market down 7% for the month. Now that's nearly all covered. The end of March was at the bottom. If you look at the chart, the blue line, you can see end of March was pretty much right on the bottom of the market. So that's when things were looking the worst. The markets have clearly recovered, and more so than on my charts, which I think I did on Friday. And we've seen recoveries across the board. Same as US shares, down 6.5% during March. But in the US, they're fully recovered completely. Global leaders, same, 7%. Fully recovered as at today. US small caps, not down by as much, but not up by as much as well. US small caps have been pretty average in the last 5 years after being the star performer for the previous 5 years before that. But they will be the main beneficiary of broader productivity growth as AI. Productivity benefits go through the whole economy over the next 3 to 5 years, or whatever that turns out to be. Emerging markets, which were the problem child going back 5 to 10 years ago, but have been stellar in the last 3 years. 17% in the last year, in spite of losing 10% in the month of March, but they've nearly recovered all of that. So they'll be looking back to those 13, 14, 15% returns, an important part of the portfolio. Now, gold has been fascinating. Gold had a massive run in the lead up to this, then it had a correction, and it actually went down during this crisis, which is quite odd. Normally in crisis like this, you get gold going up because gold is a hedge. Now, the reason it went down at the moment is just purely profit taking, and then a lot of these hedge funds that invest a lot in gold jumping out of gold into oil. So that caused them to take profits in gold, load up in oil. We still believe and really solidly that gold is an incredibly important part of the portfolio long term as a protection against not only crises, but the high debt levels in major countries around the world, including the US. So happy, as always, to hold that in there, and still had a 34% return for the year. Let's talk property, and just on the headwinds, tailwinds analysis there. We once again, falling interest rates would have kept pressure on prices going up. Rising interest rates have slowed that down. We're seeing a slowdown in clearance of auction clearance rates of properties. Certainly no price weakness yet, and that's because of these other things, which is just the undersupply. The undersupply is so strong at the moment that puts a floor. I saw a podcast on the weekend, a developer saying, the replacement costs of most properties that we all live in is now higher than the market value. And that means properties can't go down too high. It's very hard for developers to get excited about the market because they've got extremely high development costs, which keeps prices up. We'll see what budget measures come out from Chalmers and Albo this month, and whether that moves the dial. We may see some tax changes around investing, whether it's a reduction in the discount on capital gains or removal of negative gearing benefits for some. We will see how brave they are and whether they grandfather those or don't grandfather those. It's going to be fascinating to watch. So last 12 months, Australian properties up 10%. The variation, everything from only 3% in Melbourne to 24% in Perth, 90% in Darwin, etc. I thought I'd give some long-term, show some long-term results of all these states, because short-term is always interesting, but long-term is fascinating. Mortgage rates, no real change on last month. So we're in the sixes. 5-year fixed rates, best rate there about 6.4, 6.5. Once again, fixing rates can be a good thing if you want to lock in certainty, but certainly not getting any crazy discounts at the moment and paying slightly over the variable rates, which are now all sixes. Although Westpac's got a variable rate still showing up a bit lower there. Not sure that might be a discount. A charts from Performance Property, the property clock, and you'll note some slight changes. They've now adjusted their clock into 3 distinct phases. One is the red is correction, when property prices are stagnant and going down. They never quite go down a lot, but go down a bit. So you can see a whole lot of the East Coast from Sydney, bits of Tassie, regional New South Wales, and that correction phase for houses and Geelong. Then eventually, as the correction passes, you get your properties that go into and the green is the buy zone for investing. That's where they probably start to show up value, and you can see that for Melbourne coming into that. Country Victoria and parts of, and then the momentum phase where properties are going up strongly. Perth still in that phase. WA, bits of Queensland as well. And then a potential selling window for those that are looking to sell. I'm not saying you should sell, but if it's part of your longer term strategy to be selling, that window is a good time to do that. You'll see right at the top of that dial is Gold Coast, Sunshine Coast. I'll give you some long-term perspective on that in a minute. And we all know the incredible run we've had, way more than double since COVID. Units are on the right-hand side, so slightly different but similar. Ironically, Sydney, that is correcting on houses, has got momentum on units. You'll see the Sunshine Coast is slightly lower. It's into the selling window, but not quite as advanced as the houses. And you'll see Melbourne slightly more advanced into that value side on units. And Melbourne units are quite incredible value. They're kind of half the price of Sydney units at the moment, which is as high a gap as I've seen, which if Melbourne has a half decent economic recovery, and Melbourne prices will probably outperform in the next 5 years. So it's not a bad spot to be looking at for investing. But make no mistake, there's still a risk of Melbourne in terms of their debt and economic, but they do pick up strongly in migration as well. But let's have a look at that. This is Performance Properties database that goes back to 1980. And all these things are always affected by what was happening at the start. We've all forgotten what was happening. We had some recessions around there. But the black line here is Sydney. So you can see Sydney from 100,000, 80,000 back in the early 80s, up to about 1.5 million, and a clear gap over everything else. Now, Melbourne, up until 2008 to 2012, Melbourne's the blue line, was pretty close to Sydney. And then it started stagnating, going sideways and underperforming massively to the point where, Melbourne, the median house price in Melbourne is now, you can see it. It's the greenish line. So you can see it was keeping up and then stagnant. And you can see how Perth and Adelaide and Brisbane have all caught Melbourne in that last 8 years. And that's pretty much attributable to bad economic performance in Melbourne. Will that stay the same? Should Melbourne be half the price of Sydney? Probably not in the long run. They're similar capital, similar population growth. It all gets down to the economics. So Melbourne's far better value, once again, assuming we get those changes. And then bring in the other cities, and you can see Sunshine Coast and Gold Coast, which is the yellow and the light purple there, almost Sydney type territories. So does the Sunshine Coast and Gold Coast deserve to be in Sydney type property prices? Time will tell, but we're certainly seeing what causes the prices. Once upon a time, you'd sort of put Sunny Coast and Gold Coast into the Queensland camp and connected to Brisbane prices. But I find they're now way more connected to Sydney and Melbourne prices, because that's where the interstate immigration comes from, and that's where the money comes from. So people are still selling in Sydney and Melbourne at very good prices, and they can bring that to the Sunny Coast or the Gold Coast, and that's pushing up the. It's particularly, you see that rapid growth in the last, since 2020, where the median prices on the Sunshine Coast went from 600 to 1.2 million, and similar on the Gold Coast, so a clear double in a short period of time. So fascinating looking at those long term. If you're interested in property investing in the LA, we do like to do it for those who it's suitable with clear research and where there's a chance to make better than average money in the medium term. So wrapping up and just reinforcing our process. Exciting life and boring money, as always. It does work. And the basics of that is that all your investing done as part of a real financial plan, which is based on your goals and what's important to you. Portfolio designed to meet that goals, a long-term view. Then the boring stuff, massive diversification, good asset allocation, maintain liquidity. That low-cost indexing, as I said, 80% of managers underperform the market over long periods of time. So indexing is the core, means we get well above average returns, protecting against that short-term volatility through reserves, dollar cost averaging, and rebalancing regularly. Like I said, the hidden achiever. Only 3 ways to lose money, and thankfully, none of our clients do that. Panic and selling, and once again, we had no panic and selling during this crisis. We find for our newer clients, it's more nervous times. Our longer term clients, some of whom have been with us now for 25 years, just do not panic. They're interested in what's going on, but they got faith in the process and what happens to markets in the long run, which is they recover. Second way people lose money is having to sell during crisis. Once again, that just doesn't happen with the way we do our planning. And the third is not being properly diversified, and that does not happen as well. Until next time, thank you for listening. Feel free to give us feedback, and I look forward to talking to all of you over time.